Hi, and welcome to this introducing video of the topic financing, the last subject that you will have here on this semester. So today, this is a quick overview of the topic, and you should expect these different topics that I introduce here to be elaborated back in the class when we meet in class. But today, after having been watching this video, you should have an idea of a company's need for raising capital for different investments that they plan in the future. And you are going to have an idea on how to suggest this company on how to raise this capital based on an analysis of the balance structure. You also will be introduced to different financing options that the company has and how to assess these different kinds of financing options. What are pros, what are cons? So this is what you can expect going through this video. It's just an introduction video. Following this video, you will have access to videos calculating the annual percentage rate of different types of loans, but those are in separated videos as well. So this is just an introducing video. Now here is the very simplified balance that you know so very well by now in your studies here. So on your left side you have the different assets that the company throughout the years have chosen to invest their capital to do some investments in, and we divide those into both the fixed assets that you have here, of course. Fixed assets, meaning that the intention of the company when they did the investment was to keep and use these assets for more than 1 year. And then we have, of course, the non-current assets, where the intention when the company made the investment was to somehow have a faster turnover on these assets when they made the investments. And you know, up here we can talk both about tangible and intangible and financial fixed assets. And down here we are talking about things like a stock or a accounts receivable, or we can talk about cash and different kinds of current assets. So you know these different types of assets here, and we have total assets on the left side. On the right side, you see how the company has raised in capital for these investments that they have done so far. Now, the liabilities are divided into two different kinds of liabilities. So up here in the first, now it just simply here says total equity, owner's equity, would be internal financing, meaning that this type of finance or this type of capital is capital that the company, of course, owns to the owners, but they do not pay these kinds of capital back to the owners. What they do sometimes is they pay dividend for the owners, and in this number of equity you have both share capital, retained earnings, and other ways to raise some equity over here. And then we have the external capital, the external liabilities. These are the different kinds of loans that the company needs to pay back, and they pay an interest to be able to raise this kind of capital. So we have long-term debt where the payback time is more than 1 year, and then we have the short-term capital where the payback, or at least these short-term debt, needs to be renegotiated within a year. And these are very roughly spoken because, of course, it's not always cut as in 1 year or not. So you collect all of these liabilities. So you have total liabilities here, down here. And total liabilities should always be equal to total assets, as you do not raise more capital than you need for your investments. And of course, you are not making any investments that you do not pay for in somehow over here. So this would be the balance sheet, and we will go more deeply into the balance sheet when we meet in class. But the way the balance sheet, the liabilities and assets, the relationship between those two, we call that the balance structure. And we can now analyze how this balance structure, how the balance structure in the different companies look. And we do that in two types of balance structure analysis. One, the vertical balance structure analysis, and the horizontal balance structure analyzing. Looking at the vertical balance structure analysis, we compare numbers on the same side of the balance sheet, meaning we can compare numbers on the side of the liabilities, taking a look at, for instance, solvency, you know that number from previous semester, equity in relation to total assets or total balance as I've been written here, or the debt ratio, taking a look at the total debt here in relation to the total assets. How much of the total assets has been financed from the equity, so the internal capital, and how much of the investment has been financed through external capital. What is also interesting here is that we can do the same thing on the left side of the balance sheet. So we could take a look at how much of our fixed assets is of the total assets, meaning that we have this fixed assets ratio that we can take a look at, and other numbers that we will talk about in class. So this would be taking a look at the vertical balance structure. And you know from previous semesters how these different levels should, or at least should be recommended, is recommendable. Or one number I forget here is, of course, the gearing, the total debt in relation to total equity, and taking a look at these different ratios. So that would be the vertical balance structure. And we will, of course, in class discuss how to look at those and how to assess these different numbers, financial ratios that we get from these calculations by looking at practical examples. Now the horizontal structure, you can almost hear it in the name. So we are looking at horizontal view on the balance sheet. So here we compare balance sheets from the liabilities with figures in the assets. So what is the relationship between these two different sides of the balance sheet? So the first one, which is very interesting, is to take a look at the capital tie-up ratio. What's the relationship between fixed assets and long-term capital? The company should strive for having as much of their fixed assets, and it would be good to have more than 100% of the fixed assets financed by long-term capital, meaning equity and long-term debt. So this number, this capital tie-up ratio, should be below 100, meaning that over 100% of the fixed assets is tied up with long-term capital, meaning you pay it back over a long period of time. We also take a look at the liquidity ratio, the cash to current ratio that you know, and here we take a look at the current assets in relation to the short-term debt down here. And the liquidity ratio 2, or the asset test, where we subtract the stock in this case and take a look at it at the short-term debt in the denominator. So these different kind of financial ratios that you know from previous semester, we calculate them and we analyze them just the way that we did in previous semesters. And on that basis, we then suggest the company how they should raise capital for new investments, taking a look at what is the risk of taking up new external loans, what could happen to the price if you already have a high level of debt in your company, what will happen to the price of the new debt that you could expect, what risks are there related to this, what is the price on this. So of course, companies have different options to raise capital. So they could raise capital from deposits from their owners, they could sell new shares, they could retain earnings, we call that self-financing, sell their assets and then perhaps lease it back if they still need it, so disinvestments, or of course they could go for external lenders taking up loans. these financing options should always be evaluated. What is the most beneficial for the company? So of course, when we talk about external loans, what are the borrowing costs for these loans? Now, I can see there is a little miswriting in the PowerPoint, but I will come back to that in class. So the borrowing cost, we call that in English the annual percentage rate. What is the real rate, the real cost that we actually pay for the loan? Then the company, of course, needs to take place. What kind of liquidity, what kind of cash do we need to be able to generate to pay back for the loan? We also need to take a look at, of course, what kind of cash inflow can we expect if we do the investment, and what kind of cash out do we need, capital service cost do we need to have in relation to the financing option. Are there any kinds of risks related to the loan? Do the financial partner want some kind of collateral, so some kind of security by giving you this loan? And is there some kind of flexibility down here in regarding of the loan? If, for instance, you want to do an extra installment, or you want to pay back before the duration times end, then of course, how much will that cost? And if you go for a higher equity, then you kind of give up power, you give up decision rights of the company. So of course there are pros and cons for these, and we have gathered it together here in this small table. Now you can press pause. I'll not go through all of them, but read the slide, and you can also read that in your book as well. When we talk about loans, you are going to be taught about 3 different types of loans. You're going to be taught about a bullet loan, a kind of a fixed loan, where you actually throughout the whole duration time pay only the interest. And then at the last payment, the last installment, you will pay back both the interest, of course, but then the whole principal. Now, this would make that the outstanding debt profile would look like this. You remain the total principals as your remaining debt until the very last installment. We will look at that closer in the following videos where we look at examples for this. But this is called the bullet loan. Serial loan is where the principal is paid back in equal installments at each payment date along with the interest. So the installment in this case is the fixed amount, and then the interest will keep on falling as the remaining debt, of course, is also becoming smaller. So as the installment, the total installment is both the actually repayment of the loan and the interest, then the installment, the payment that you make every time you have a term will be different. And the remaining debt profile will look like this, like small stairs. You will cut off the same amount of your principal every time you make a payment. And then the last one, the annuity loan, where we have a fixed and equal payment every time we make a payment, an installment, meaning that at the beginning of this kind of loan, you will have very high interest to pay. And then at some point, you will start to have a higher and higher repayment or installment of the total loan, making the remaining debt profile looking like this. So this was just a quick introduction to the whole financing topic. There are many more details to look at when we are getting together in class. And as I said, there will be some different videos calculating, showing examples of the different types of loan and the annual percentage rate. See you in the other videos.